Today is mainly focused on the business of oil. 8 members of the OPEC Plus group, including Saudi Arabia, Iraq, Russia, and the United Arab Emirates, yesterday agreed to increase production by a combined 137,000 barrels a day next month. Apart from perhaps Saudi Arabia, UAE, and Russia, others may struggle to increase supply as they are most likely already producing at near capacity. Sunday's announcement implies the group is beginning to fast forward the unwinding of a second set of voluntary production cuts in place since April 2023, totaling 1.65 million barrels per day. The 8 countries have already raised oil output by about 2.5 million barrels per day this year, having rapidly unwound a first tranche of production cuts since April. Hello, this is Global Business Insight, where we probe in more depth into the main headlines and share perspectives and thoughts on implications for the business community in the very dynamic context. In the recent World Oil Outlook 2025 report issued by the OPEC organization, a need for an all-encompassing approach to future energy pathways and energy security closely linked with efforts to reduce emissions and ensure sustainable development was presented. The outlook did not see any energy source in isolation or dismiss anything. Rather, it accepted the empirical realities amid a host of economic policy-driven and geopolitical uncertainties. The report also noted an ongoing recalibration as nations navigated an array of complex challenges, also noting the noticeable trend of policy pushback and intensified scrutiny, primarily in the US and in a number of other developed countries. The report highlighted that global energy demand is set to expand by 23% in 2050, driven by expanding economic growth, rising populations, increasing urbanization, new energy-intensive industries like artificial intelligence, and the need to bring energy to the billions who do not have it. The developing world, that's the non-OECD countries, constitute the countries that are going to be fueling the increase in the near and even medium term. The World Oil Outlook observed that the mindset of swiftly phasing out oil and gas is unworkable and actually a fantasy, with little regard for realities of energy security, affordability, or feasibility. This mindset is, however, shifting also as the data shows that out to 2050, oil demand continues to expand to reach 123 million barrels a day, with no peak oil demand on the horizon. That is in the baseline scenario. The OPEC report finally called for a proactive and constructive approach to investments in areas such as carbon capture, utilization and storage, direct air capture, and the circular carbon economy. This was to ramp up a reduction of emissions and implement lower carbon solutions. Apart from the baseline, most likely scenario reference or the reference scenario, OPEC saw 2 other alternative scenarios presenting different but viable outcomes. The technology-driven scenario assumes accelerated investments in advanced technologies, resulting in both significant fuel substitutions and energy efficiency improvements that lead to lower primary energy demand and a significantly different energy mix. In this scenario, there was a demand gap vis-à-vis the reference case of close to 5 million barrels per day in 2035, which then expanded to 16.7 million barrels per day in 2050. The second scenario, that's the equitable growth scenario, describes a more equitable and prosperous economic future for developing countries, coupled with a differentiated approach to how and when to achieve emission reduction targets. This scenario therefore saw higher long-term energy demand, with oil demand in this scenario reaching 120 million barrels per day by 2035 and growing to 130 million barrels per day in 2050. But going into the meeting of the 8 OPEC plus countries yesterday, gathering to consider further unwinding of production cuts, you recall in early August, a decision was taken to boost output by 547,000 barrels per day. That's for September, which completes the rollback of 2.2 million barrels per day voluntary cuts. But there is another 1.65 million barrels per day, which can be unwound, and these cuts were to have been in place until end of 2026. Oil prices have been subdued for most of the past several months as OPEC Plus began in April to unwind production cuts. A decision today by OPEC Plus producers to tap the last 1.65 million barrels per day cuts would signal that they are back to chasing market share. Market share comes at a cost of lower prices, which threatens country budgets, and in many basins like in the U.S. shale patch, can also lead to a decline in drilling investment. Also, actual OPEC Plus's production has been short of pledged amounts, like I said, as most members already pumping near capacity. So mainly Saudi Arabia, Russia, and UAE are going to be able to easily add more barrels into the market as analysts speculate on what happens to the 2 layers of cuts that are still in place, the 1.65 million barrels per day cut by 8 members, and also the other 2 million barrels per day cut by the whole group in place until the end of 2026. There is already a significant risk of a supply surplus, and sentiment is bearish on the price outlook, weighed down by rising worries over the health of the U.S. economy, where job growth slowed last month. The U.S. is also looking to pressure buyers of Russian crude to push Moscow into agreeing on a truce in Ukraine, imposing a 50% levy on some imports from India. But additional supply is expected from Guyana and Brazil. OPEC Plus have succeeded as a body of southern nations despite much skepticism on the value added in stabilizing energy markets. In 2016, OPEC member countries and 10 non-OPEC oil-producing countries in a landmark agreement, the OPEC Declaration of Cooperation, entered into this collaboration, bringing together 23 oil-producing countries to support sustainable stability in the global oil market through cooperation and dialogue. The DOC played a pivotal role, particularly during the COVID-19 pandemic, and confirmed OPEC's savvy in dexterously managing global oil markets at a time of extreme turbulence and uncertainty. In April and November 2023, OPEC Plus members agreed voluntary cuts of 2.2 million barrels per day with a plan to gradually unwind these cuts starting from April 2025. Again, this was a coalition that came at a time when difficulties in agreeing production cuts were threatening to split the organization. Indeed, institutional flexibility has helped keep the OPEC boat afloat. While prices need to be stable and high enough for steady investments, the debate on the long-term outlook and narratives on peak oil demand and supply have to be accurately shaped, knowing that oil is a finite resource, and once extraction surpasses a peak, production will naturally wane due to decreased reserves and newfound challenges to extract these finite resources. Peak demand is also driven by technology and business environment facing tepid economic expansion and an uncertain transition to non-fossil fuels. Despite past generous increases in supply by OPEC Plus, prices have remained stable, though keeping sentiment bearish given the sense of ample supply. The geopolitics and tension points around supply, either from new sanctions or other global developments, have also always seemed to offset the demand lull from a slower economic growth trajectory. Saudi Arabia has continued to remain on the driving seat and for now is juggling maximizing both revenue and market share. The potential lack of cohesion and division amid members facing increasingly tighter fiscal space and who will in the near future find it more and more difficult to see the longer-term market share or other advantage cannot be ignored. Ultimately, like we saw Angola recently do, we could see more exits. More special coalitions also are possible, and we could see some type of plurality thriving within OPEC as the odds of a split continues to rise. For OPEC Plus to remain intact and succeed in the longer term, it needs to move more, I would think, to support members in building also competitive advantage in their basins and less into being focused on fixing production quotas and ceilings, and of course juggling increasingly complex compensation and punitive processes. Nigeria production is expected to rise to 1.7 million barrels per day in Q4, above its 1.5 million barrels per day quota, which is still well behind its peak of close to 2.5 million barrels per day that was in 2005. It could be positioned for a modest increase at the next quota reset. On prices, it's hard to see the Brent standard average price over $70 amid the backdrop of weak demand. Prices will also remain volatile, driven by the hard-to-predict geopolitics. To other business news, it is a busy week for data, and in the US, where markets are focused on August CPI data out this Thursday. A strong upside surprise can derail the optimism around cuts. Analysts are debating that while a stalling labor market and tepid inflation figure may justify an interest rate cut, a lower Fed funds target rate is unlikely to boost hiring or materially improve employment conditions. This is as businesses need certainty and stability around trade policy, a situation recently worsened by the Federal Appeals Court striking down of the president's use of emergency powers to hike tariffs. As the Supreme Court decides, the process does not help the clarity that business needs. Also, all eyes are on Fed Governor Lisa Cook, the mortgage fraud case and how it's resolved. But apart from inflation and oil prices, there are other things going on. OpenAI is developing an AI-powered hiring platform called the OpenAI Jobs to connect businesses and employees. The company expects to launch the service by mid-2026. OpenAI CEO of Applications Fiji Simo said the service would offer a dedicated track for small businesses and local governments to access top AI talent. Still on AI, Anthropic, an artificial intelligence company, agreed to pay $1.5 billion to a group of authors and publishers after an American judge ruled it had illegally downloaded and stored millions of copyrighted books. The sum, $3,000 per work to 500,000 authors, could be the largest publicly reported copyright recovery in history. And in the UK, businesses are hoping to see a dilution of the flagship package of employment rights championed by Angela Rayner after her exit. The bill is one of the centerpieces of the government's agenda, cracking down on practices such as 0 hours contracts and fire and rehire. Business leaders argue that reform strengthening employee rights will create new costs and risks on top of recent tax and minimum wage increases. Asia-Pacific markets traded mostly higher as investors digested Japan's Prime Minister Shigeru Ishiba's resignation announcement over the weekend, also as China's exports data came in. The yen also fell broadly following the resignation news. We saw oil prices up 1.6% as OPEC Plus agreed yesterday in an online meeting to raise production from October by 137,000 barrels per day, which was much lower than the monthly increases of about 555,000 barrels per day for September and August, and 411,000 barrels per day in July and June. Brent crude standard was still under $67 a barrel in early morning trade. China's exports to the US fell 33% in August as overall growth slowed to its weakest in 6 months, partly due to US crackdown on transshipments and as the impact of front-loading exports wanes. Well, that's all you can take on this episode of Global Business Insights. This is Bode Oshosami. Bye for now.